A little bit of technical difficulties, but I at least have my guest here. I have Rick Gunzik, and I invited him on the first show because, everybody doesn't know what to do about the interest rates. With interest rates going up and down and all around, Rick, can you tell us what's going on with interest rates?
Well, one of the things Sharon asked me to talk about specifically was every time they say the Fed just raise rates, you've got to refinance now. Everybody, every newscaster there will come on TV saying mortgage rates are going up, mortgage rates are going up, and we just want to dispel that myth, that rumor. It never happens that way. The mortgage market is a gigantic market. It's $1 trillion market, and rates are on a combination of factors. Mainly, they follow the 10-year Treasury bond. I don't want to get too technical because it can get really technical, but interest rates follow the 10-year Treasury bond, and they also follow what's called a UMBS, and that's a Uniform Mortgage-Backed Security. And those trade on the stock exchange like a stock every day. And that's why rates change
constantly. Every day, constantly.
As Sharon knows, as being a loan officer, sometimes rates will change 3-4 times in a day. And that's because it's a constantly moving market. And it's a big market. It's a $1 trillion market, like I said. So when the Fed says we're raising rates, it's done for a variety of economic and macroeconomic reasons. In this case, inflation got way out of hand. You've seen the news on that. Inflation is at a 40-year high. We were in the 9% range for inflation. And actually, the government tweaks those numbers. So if you look back historically, our inflation rate, if we were in 1970, is comparative to like 17% right now. So you can see how high our inflation really is. So they're trying to slow down the economy, and that's why the Fed will raise rates. Now, what that does tie into is credit card rates sometimes will go up because of that.
Well, like I saw on the news, Rick, I saw ABC News. It said ABC News. The Feds are going to be meeting, and when they meet, your credit card, your car payment, your house payment, everything's going to go up. Mm-hmm. And they're scaring everybody, and the scare tactics are ridiculous. You even see people getting on YouTube and TikTok and talking about how interest rates are just skyrocketing, and people are sitting on the fence. And with these real estate transactions, what do you tell people what if I buy a house and the interest rate goes up before I close my deal?
Oh, well, unfortunately, there's two ways to fight that. One is you can ask your loan officer to lock far in advance. But one thing is don't listen to the news so much on interest rates because they have no clue what they're talking about.
So you're telling me the news has no clue what they're talking about with interest rates?
They really don't. I mean, there's an indirect effect that's very indirect. For instance, mortgage interest rates really started flying upwards in March and April, and the Fed didn't really start acting until June. So they're 3 months behind the curve as it was. And, they could have seen it coming. Everybody in the mortgage industry, well, I shouldn't say everybody.
Not everybody knew it was coming?
A few companies went out of business because of it, because mortgage companies, live and die on the interest rate. And if they don't see it coming or moving quickly, they can go out of business because of it. So that happened to a lot of mortgage companies just this March and April. A lot of the bigger
well, I heard a lot of the big companies laid off anywhere from 30 to 50% of their loan officers.
Yeah, now rates did go up, but it wasn't an effect because of the Fed. It was because of everything else that was going on, and mainly because everybody saw the inflation rate going up. Now remember, these bond traders are more sophisticated. They're more sophisticated than your stock traders, so they know what's going on in the economy because they watch it because their profits are really tied into the economy.
So what do you tell somebody who's looking to buy a home right now and they're saying, well, I'm sitting on the fence because I think the houses are going to go down in price and the interest rates, they know interest rates are going to go up. So what are they waiting for, and what would you tell them if you were their loan officer?
Oh yeah, it's still a tricky situation. And we're still getting a lot of home buyers too. It's not like people have stopped. But it's you kind of got to weigh the options. You need to refinance, a terrible time, of course, unless you need the money for something. Because rates did jump significantly since that period in March. We went from 3.5% to 5.5%, 6%. So it's quite.
But now we're right down. We've come down to what, 5.25 now?
Yeah, we're in the 5.25 area. But historically, what you got to remember is anything under 6 it's really cheap money, to be honest with you.
Right.
So if you have to buy a house at 6%, you're not losing anything. So,
Well, you know, the other thing I wanted to mention is, you know, the different types of loan programs out there and the different types of first-time home buyer money that's out there. And, you know, that money doesn't stay there forever. So when you are talking to a client about FHA versus conventional, what would you tell a borrower that says, well, I want to go conventional because I don't want to have mortgage insurance and get down payment assistance program, but isn't FHA a lower interest rate?
yeah, FHA is right now, it's about 1% lower roughly. So we were talking 5.25%, let's say, for a conventional loan. And FHA, you'll probably be down around 4.25%, 4.5%.
So we're still at 4.25 to 4.5.
Yeah,
On a 30-year fixed rate loan, if you go FHA.
right.
And so what are people complaining about and why are they sitting on the
Yeah,
fence,
people
right?
just get spoiled, you know how it is, and they saw that they missed 2.75. I mean, we get some people 2.75
Right.
back in
I
the-
got like 2.625.
Yeah, back during the virus, and we were getting people really, really low rates because the economy had slowed down so much. Now, the economy didn't slow down because of the Fed. The economy slowed down because the economy was slow. And you might call it government induced because they shut it down. But you know, it's still, you're right. It's cheap money. And I remember my dad bought his house in 1965.
1965, yes,
Yeah,
because,
And he
yes.
had 6%. So think about
He
it.
had 6%?
He had 6%. So if you go back all the way to 1965, I mean, you're getting really cheap money. And if you're a business owner, like if you're looking for a loan for your business business loans are always in the 10 to 12% range. So you can see what a difference that is. And it makes a lot of kind of like your time in life. If it's the time in life when you want to buy a house and move up, it's still a good time. Prices have actually dropped. Sharon's more involved in real estate than I am. I'm mostly homes, mostly the mortgages. But you've seen listing prices drop now, right?
Well, the listing prices, and that's what we're going to do also, is we're going to have some of my agents come in and speak and talk about, you know, the new agents on their first deals, how it went down. I have an agent right now who's going through his own real estate transaction. Literally, he is just tested for his real estate license, wanted to list his own home, and we just were unstaging the house today.
Oh.
And so he sold his home, and he bought his new home, and you're doing his loan. And well, it's actually Susan's loan.
Oh,
His
okay,
wife,
yeah.
his wife's
Nice
loan.
couple, huh?
Yeah, it's a couple. And you know what? The thing is what people are not understanding is, okay, yeah, the interest rates are up, but the prices are coming down, and most of the prices are dropping anywhere from $30,000 to $50,000. But that's because they were up by $30,000 to $50,000. So they're just balancing out. So when we first thought about listing their home, we were going, okay, well, the house down the street sold for $865, and we should be able to get, you know, the same amount because it's the same kind of house on the same street. And you know, we put it up for sale at did I say 8? It was $865. And I said, well, if we go $830, we might get, you know, more people in instead of at that other rate. But right at that point, the interest rates went up. And when the interest rates went up, the buyers just stopped. And and the thing that I want to get out there to a lot of these buyers is they're sitting on the fence like this, waiting for something to happen. But as you know, and I know, we've gone through the ups and downs of real estate. And what happened is people are thinking that we're going to see what we had when all the house price dropped and all the people were losing their homes. And so can you explain what happened then? Why did the housing prices drop at that point?
Back in 07?
Yeah,
Or 06?
06, 07?
August 06, actually, what it was. It's sort of all the
Blame it
time.
on August.
You think I should know it. It was a crisis for the mortgage industry, of course. And that was a whole different
It was a whole different
It
reason.
was a whole different reason, yeah. It wasn't because the economy slowed so much. It was because they got crazy on that gets really complicated.
Those stated loans, right?
You'd understand it very well because it was negative AM stated loans. And then negative amortization loans, most people won't remember them now, but what they were is you had a choice of 4 payments. And one payment was barely enough to make the payment. It was 1% to.
You know, I have one of those on my condo. on one of my rental properties.
Yeah.
It's called a pick-up payment loan.
Yeah.
And unfortunately, the loan officers didn't explain to the borrowers that if you pay the lowest payment, your principal is going to go up.
It goes up.
If you pay the middle payment, your principal stays the same. And if you pay the higher payment, your principal goes down. So nobody explained that to them,
Yeah.
so they're paying the lowest payment.
Now, this actually was a good loan.
It's a great loan. I love that loan,
When
especially for
World
investors.
Savings started, remember World Savings?
Yeah, that's why they're out of business.
Excellent lender. Well, they limited it to 80%. Remember, you had to be 80% loan to value.
So you had to put 20% down on those?
Right, with World Savings. But then, I think Wachovia bought World Savings and then Wells Fargo bought them. But what happened is they turned, not World Savings, whoever bought them, turned it into a 100% LTV loan. So now people,
When you're paying the lowest payment,
and you didn't put anything down on your house to boot,
now you owe more on your house than it's
than
worth.
they even worth. So all these people owed more on their house than it was worth after about 12, 15 months. And it just created a situation where they found out about it, so to speak.
Well, that's because somehow they found out about it. They
Yeah,
decided,
just with Zillow, whatever. And
Yeah.
they say, oh, my house is only worth 8 and I owe 820. What's that? And so all of a sudden these people who were stated income to boot.
yeah, so stated income means they didn't have to prove their income on
Right,
their
and we
loan.
saw a lot of maids and gardeners making $20,000 a month, and you know
Maids and gardeners, I think I should become one to
yeah,
make $20,000.
you knew we had a ton of these loans from up north. I'm not saying anything about people who live up north, but for some reason we had, I think because housing prices were higher,
Yeah,
or typically up north, and San Jose, San Francisco area, and we got a ton of people that don't normally make more than a few $1,000s a month, making insane money, and we turned them all down. One time we got 33 loans from this one broker. We turned down 30 of them,
wow.
and he couldn't sell them. So I don't know what he ended up doing with them long term. He's still in the industry, so he figured out something to do with them. But we turned them all down. They were obviously fake income. They were stated.
So the drop in the housing prices, it was
a program induced, that.
it was the loan programs that people got,
Yeah.
and then they had payment shocks, so they couldn't make their payments.
Yeah.
But now the people that are sitting on the fence are thinking, okay, housing prices are gonna come down, and I'm gonna sit on the fence and wait till the housing prices come down. Well, while you're waiting for the housing prices to come down, the interest rates are going up. So while that's happening, you're just getting yourself into a situation where you're never gonna be able to buy
Yeah,
anything.
and the problem now, which is really difficult to understand, is prices just keep going up. And now, granted, we just said they went down a little bit, but I mean, I think that's a micro dip, to be honest, like a 10 or 15% dip that we're going to experience right now, just because of
Do you think housing prices are gonna stay the same or go up or go down? What do you think?
I'm hoping we kind of stay flat for 3 to 5 years.
Well, I'll tell you, in the last 3 months since the interest rates went up, I have been busier than I've ever been.
Right, and we've been surprisingly busy too.
Right, because it's actually at a point where people feel like, okay, so the buyers that were out there that were being outbid all the time, they were bidding and bidding and bidding, and they weren't getting anything because there was 20 or 30 or 40 bids on a house, and they got frustrated and they stopped looking.
Yeah.
And then the interest rates creeped up a little bit, but you still can buy, and I don't know that they know that they can jump in now and actually, Courtney, the real estate agent that just closed the deal, we went out with her clients the first time, the first offer in, her first deal, and it was accepted.
Oh, wow.
And then another one that we just closed, it was the first offer we wrote for them too. So on the bidding war front, it's really not a bidding war anymore, because there's, if it's very possible there'll only be like 1 or 2 people, if any, because like I said, the buyers are sitting there waiting for something to happen that's not going to happen. They think that the housing prices are going to go down, but the housing prices aren't going to go down because we still have a housing shortage.
It's still a shortage, right? I think the latest numbers from CAR show there's still 100,000 houses a year shortage.
So Rick just said the latest number from CAR. So what CAR is, do you want to explain CAR?
You tell
I'm
CAR.
good at it because I'm actually a CAR director, and that's the California Association of Realtors. And basically, they put out statistics all the time, and they're there to help homeowners and to help people who own land protect their property rights.
Yeah, they actually have really good economists that predict
We have a
this.
really great economist.
Yeah, they're actually really sharp. They predict this stuff all the time. I usually pick on economists, but this guy's actually really good.
I think who you're talking about, we actually did dinner at the Inman's conference.
Oh, see, yeah, again, these guys are pretty sharp.
These people they know what they're doing, the people that are going to these conferences, and depending on why you're watching about real estate, you could be wanting to invest in real estate, you could be wanting to be a real estate agent. Flipping houses right now, it's really, really tight if you have questions on flipping houses, because like Courtney has a listing appointment that we just talked about today, and we were talking to the owners, and I looked at the numbers, And it's very, very, very tight for flippers because you have three main types of buyers. You have the buyers who, they want to buy the worst house possible, but you know what? Nobody really wants to drop their prices that low. So the flippers can't get them cheap enough to flip them. And then you have the person who, well, we want to be in the area. That's the person who's going to give you the most money. We want to be in the area because our kids want to be here. And maybe they'll buy a house that's not so good. But for the most part, people like the homes that are completely redone. So when we looked at the numbers, I said to the homeowner, I said, well, a flipper is going to give you about $850, maybe. Okay. Somebody who's moving into the area that wants to have their kids in the schools over here, they'll give you about $925, maybe. But if you completely do it and gut it, you'll probably get 1.1, 1.2. So the number spread is like, but you have to put $200,000 into the house to make it that way. Yeah, so the market really is there for people that want to buy a home, move in, and be in that neighborhood. I think those people are the ones that are getting the homes and being happy with the prices they're getting.
Yeah, and what I've seen a lot of too lately is if any of you are veteran buyers.
Oh my gosh, the veterans, yeah.
Veterans loans are great, and we've gotten a lot of veterans actually in the last 2 months, 3 months. And I think that's partly because
they're all from my real estate agents. Your veteran loans.
Yeah, and I think they don't like dealing with the stupid bidding wars that go on. So now they can buy nice and comfortably, and veterans don't have to put any money down. So it's a great
Not only is no down, but also what about the fact that if they have 10% disability or more, and a lot of them have at least 10%.
Yeah, most do.
They waive the funding fee, and on the VA loan, there's no mortgage insurance.
Yeah, which is another great factor of those loans.
Wait, and the even better factor is what they just recently did, and they stopped the loan limits. So a veteran used to have loan limits like FHA. So FHA has loan limits depending on what city or what county you're buying in, and they limit you on how high you can go on your loan amount.
Mm-hmm.
But on VA, they made it so it's endless.
It's essentially unlimited, but with limitations. But
but they get the interest rates, and one of the loan officers when I was teaching the loan class the other day, he said that he did a VA loan at $3 million.
Yeah, you can go pretty high on them, which is surprising.
Plus, you get the better rates.
Yeah, and some veterans do really well, so so it's a great loan for them.
So what else can you tell us about interest rates, or what you see happening? That's the one thing people ask me of what your crystal ball is saying, because I always brag about how you always tell me what the rates are going to do.
Yeah.
And I know that when we first talked about when the rates were going up, you thought we'd see like 6.5 in the summertime. And that other guy that we were talking to said 10% by the end of the summer.
Right.
What do you think is going to happen and how long? What kind of timing do we have?
I'm closer. But because I watched the 10-year bond, and I've charted the 10-year bond. I wanted to show you folks a chart of the 10-year bond.
We were going to show you a chart right here on the handy dandy TV.
And
technical difficulties.
Yeah, and the chart is surprisingly accurate. It looks like hocus pocus when you see how accurate it is. But so I see them coming back down short term into the. Let's see, I gotta equate it to the right thing.
Remember, I have some people I need to lock in.
Yeah, on a 10-year bond. On a 10-year bond, it's at 2.87 today, I think it is. We got as low during COVID. We got as low as we were hovering around 1% or something. And oddly enough, we actually, I can take credit for this. I actually got it written somewhere. We took credit. I predicted 1% a long, long time ago.
So I remember when a few years ago when I went to the conference with the board of realtors, they had these big economists come in, and I called you and I said, well, they say interest rates are going to go really high, and we're going to have to do short sales, and we better learn how to do adjustable rate mortgages and all this stuff. And you said, they're so wrong. And I'm like, what do you say that? And you said, in October, the rates are going to come down to the 2s.
Yeah.
And that's when they came down the first time as low as the 2s.
Yeah. And I'm just watching this chart. The chart goes up and down. Now, there was a 30-year bond market rally, 35-year bond market rally, and it ended about, 2-3 years ago. The virus kind of threw off the timing of everything. So essentially what they're looking at is long-term, everybody feels bonds are going to slowly climb back. Well, the price would go down. And so the value, it's an inverse relationship, so it's hard to explain a lot of times.
So when the bond goes up, the rates come down.
Yeah, and when the price of the bond goes down, the rates go up. So that's supposed to happen for the next 35 years. But it won't happen
overnight.
It'll happen over the course of 35 years. So in other words, we'll probably stick here. I think we'll go down again into the 4.5s, for mortgage rates with no problem. We're pretty close.
When do you think we're gonna get to 4.5?
Certainly October.
Because October, we always see the best
October,
rates.
we always see lows for the year, yeah.
And people don't know that because in the summertime, they all wanna go shopping for a home so they can get their kids in school. And then as soon as the kids are in school, all of a sudden, the interest rates come down.
Yeah, and typically, and her and I've watched it for years, it's typically lower in October. Well, there's some anomalies to that, but for the most part, October is always the best. But what I would see is, I would long term, I'd see us hitting this 4.5 area in mortgage rates for quite a while, 3 to 5 years.
Okay,
And
because what is this crap about people saying, like that one friend of ours, I didn't want to say his name, said summertime we're going to see 10%, and everybody was saying 10, and then I called you and you're like, I don't think we're going to see 10% for a while.
Yeah, I think it's Chicken Little thing. It's everybody runs for the sky is falling kind of thing when it happens, and I just didn't see 10 happening. It was too quick because it would have crushed the economy right away. I mean,
I saw we hit 6, and then we came right back down to 5.5.
Yeah, and I think we just got I mean, think about it. We had a really extended move for like 1 month. Rates went up fast. I mean, we went from that 1%.
I felt like we went from 2 and 3/4
Well, essentially,
to
the
10.
way we felt it, because we're doing the mortgages and we're trying to get everybody 2.75. We felt like we went from 2.75 to 6 in a week, but it was really about a 6-week course. But still, that's fast, you guys. That's like, I mean, that's enough to put big mortgage companies out of business quickly. And there were 3 or 4 large ones that went out of business because of that. Because what they do is they hedge their portfolio against bond prices falling. And they didn't hedge because they didn't think they needed to. And boom, you're out of business.
Boom.
All of a sudden you have...
And boom, you're out of business.
Well, you have all these loans at 3% that you're trying to sell, and everybody wants 6% for them. So you either pay a haircut on them and eat it in the shorts, or you go out of business, and they just went out of business.
Well, the other thing I want to mention is, I teach the mortgage classes, and I teach people how to get their mortgage license. And, there for a while, while the interest rates were really low, I had packed classes constantly. And now I'm still having some pretty packed classes. I kind of joke with them and say, you guys missed the wave, but they really didn't, right? This is still a great business
No, it's still a great business to be in. I mean, we've both been in it for years now. No, I'm kidding. I don't want to tell our ages, but Sharon's 35 plus. I'm 30 plus years in this.
Yeah, so 35. I started when I was 2. No.
But yeah, I mean, there's always a place to make money. I mean, there's reverse mortgages.
But we talked about reverse mortgages, and
it's not the right loan for everyone.
It's not, and the problem seems to be that the people on the backside. I was talking to a guy that used to work for AAG. He was in the haircut because they laid off a bunch of people, and he was saying that you could see how much money they were making on the backside, and they were making a ton of money on the backside, and they were actually selling a decent interest rate, for the reverse mortgage. And then when the interest rates went up, they somehow they must have went up so much that the amount of money that the big companies were making went from like 15 points, I did say 15 points, to like 6 or 8 points.
Well,
and so the money that they were making went down so much, that's why he said that they laid a bunch of people off. But yet the rate on a reverse mortgage right now is 8%. And you're sitting there saying 8%, that's ridiculous. And you've got to watch out because, they're saying, well, you don't have a house payment anymore, so who cares about your equity? Well, the lady that I was working on trying to get it right before the rates went up, she was at 6, and we thought we were going to be able to bring her down. We were going to save her $2,000 of equity a month.
Yeah.
So it does matter to people. And
it does matter.
And for, if you're working with a loan officer that says it doesn't matter, it does matter. And the loan officer should be gearing everything towards what's the best for my client.
Right.
And a lot of them aren't doing that.
Yeah, and it depends on your client too. Like if your client in this case has no kids or whatever, no heirs at all, I probably would say it doesn't matter. But if they have 3 or 4 kids that are hoping to get some chunk of nest egg, then it's going to eat up all their equity. So that's a whole new show. That's a whole new. I mean,
there could be shows on what type of loan should I get, and the other kind of loans that when I'm teaching these classes, and it's really sad because a lot of the stuff in the regulations they don't even happen anymore, but yet they're testing them on them.
Yeah.
Like the HARP program, which is the helping people lower their interest rates when they were at high loan to value.
There's a neg am question on there too.
Yeah, there's a lot of neg am. There's no neg ams anymore, right?
No, there's none.
They're not available at all.
Yeah, they illegalized them.
Okay, so negative amortization loans are illegal except for reverse mortgages or negs.
Yeah, yeah.
Technically. And what cracks me up about that is, we have to do a whole section for the loan officers to understand how a neg am works. But do we still have the interest only like hybrid loans that's fixed for 3, 5, 7, or 10 years?
Yeah, they do have those. That's more in the non-QM space. They don't have them in the conventional area yet. Non-QM can be a whole
So the rate's still higher then. I mean, the whole point of a short-term loan would be to get a better rate.
Yeah, and the non-QM loans are in the high 6s and 7s now. So.
Yeah. Well, the one that I mean, remember when there used to be a conforming, like 3-1 arm?
Yeah, those haven't really made a comeback yet. I'm surprised
Do you
they
think
haven't.
they will?
Yeah, I always liked them. I don't know if you remember the 3-2-1 step downs or step ups, whatever.
Those are good loans.
They were cool loans. They were it was a hybrid fixed adjustable. In other words, it was when rates were 10%. When we started, rates were 10%. And I remember we were so happy when they got below 10. It's like, oh, rates are below 10%. And but remember back then you had like a 7, 8, 9, 10 rate. So you'd go for 1 year at 7%, 1 year at 8%, and then 9%, and then 10% for the rest of the loan. And they were great loans for starter home buyers because they could have a cheap rate for the first 3 years, and they knew what their payment was going to be, unlike adjustable.
So in wrapping this up, what we're saying here is, people just got really spoiled, especially the younger kids that are now stepping into buying homes. They got really spoiled with hearing the words 1% or 2.5% or maybe even a 3% loan. You're thinking we're gonna be at 4.5 to 5.5 for a while?
For a while. I think we'll be there for a while. I still think
so get off the fence and buy a house, right?
It's still a good time to buy if you're.
It's a great time to buy because the longer you wait, the more possibility you won't get one.
Yeah, and I probably wouldn't be buying a non-owner right now for investment right now. I'd wait a little bit just to see, but I don't think we're going to fall much more. I certainly don't think LA and Orange counties would fall more than 20%, and I think we're already down 10% to be honest. And you don't see any pain in the streets. Nobody's running around screaming.
No, yeah. All right, so this is Rick, one more time, Rick Gunzik. He's my interest rate guru, and whenever I have an interest rate question or I'm looking to help a buyer get a new home, that's who I send it to. So if you have any questions for us, feel free to contact us. You guys all know my number. It's 714-745-6348, and feel free to comment and let us know what you think. Thank you, and watch for us on next Friday at 3:30. That's it, and then you hit end. There, yeah.